Steele. Welcome to Bloomberg Commodities Edge, where we focus on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. All right, want to get right down into Data Dig. We're going to take a look at some of the top market stories of the week. So we want to kick it off with some big revisions for demand for oil. You have the IEA, EIA, and OPEC all lowering their demand estimates. The IEA in particular lowering its demand forecast by another 300,000 barrels of oil a day. Now that increases the pressure on OPEC to not put more oil on the market. And it is day 2 of the Biden administration. You got clean energy stocks have gotten a boost overall. Here's the potential why. A Bloomberg NEF report showed that more than $500 billion actually flowed into climate-friendly sectors for last year, from renewable energy to electric vehicles and batteries to green hydrogen, and spending is even going to increase this year. Let's stay with Biden for a second. The rhetoric is he probably put the lid on the Keystone XL pipeline, but for good this time. Energy Aspect says, though, don't worry, not going to have a huge effect on Canadian oil. So this graphic actually shows pipeline expansion that takes oil out of Canada to the U.S. And you can see here that by 2023, over 1.2 million barrels of additional pipeline capacity out of Alberta in total is either planned or a possibility, and that's regardless of the Keystone XL. All right, let's get into the ring. We're taking a look at the rally in agriculture. You have wheat, corn, soybeans, all taking a break over the last few days after a very big rally. Want to get some insight, though, with our senior agricultural reporter, Isis Alameda in Chicago. Isis, good to see you. First off, what led the rally? Why the decrease now?
Thank you so much for having me, Alex. Yeah, I think China. That's all we can say about, the leading up to the rally. I think we had phase 1 trade deal. We had China buying way more than people had expected, even though they did not meet the deal's targets. As it looks for now, they did buy a lot more. They bought a record amount of corn, but they bought some 33 million tons of soybeans. That amount of purchases, then, that's what started it off. It was a demand-led rally. And I think on top of that, more recently, we had basically issues in South America with the weather, both in Brazil and in Argentina now. And I think that just added to it. I mean, yes, the market came down on the past few days a tiny little bit. And, it's bound to happen when you have such a big rally. The weather improved in South America. The harvest started in Brazil. That is all normal. But I think that for the first time in a very, very long time in agriculture markets, we have two things going on at the same time, which is a demand-led rally and a supply issue.
So which ag commodity is going to have the most upside here?
Wow, I'd love to know that myself. I can tell you, but I think the grains have great potential. We've seen what potential soybeans have. We've seen the potential in corn, and I think that for a while people talked so much about soybeans because of the trade war, but in reality, soybean exports are sort of returning to normal, to what they used to be before the trade war. And corn is the new thing because China didn't buy all this corn from the U.S. before, and now it's taken some 10 million tons or more. And it's a really exciting thing for the markets. But funny enough, you even started seeing things like sugar rallying quite a bit because of, demand as well. We've seen demand in Indonesia going up. We've seen demand in China as well, at the same time as you're starting to see crop issues.
Great stuff, Isis. Thank you so much. Bloomberg's Isis Alameda. Time now for Commodity in Chief, where we talk to one executive in the commodity world. This week, we're going to hear from HOLLUB, CEO of Occidental. First, we take a look at her company and its efforts with carbon capture. It is the new holy grail for oil companies, that net zero emission target. One big part of that is direct air capture. Here's how it works. A machine pulls the air directly from the atmosphere. It's like a fan, an absorbent, then attracts the CO2. You then remove it from the machine and inject it into rock, cement, or an oil well. Now, the rest of the oxygen is then pumped back into the air. It can tackle current pollution plus old CO2 still lingering in the air. Now, there are only a few commercially operational facilities in the world today, like Switzerland and Iceland, run by startup Climeworks, and in British Columbia, run by Carbon Engineering. Now, they just raised a few $1 million so far, but that number could get a lot bigger. Enter Occidental, one of the leading U.S. producers in the Permian Basin. Now, one of its subsidiaries teamed up with a private equity firm to form 1.5, which in turn is teaming up with Carbon Engineering. 1.5 provides the financing, Oxy provides the knowledge on carbon and injection, and Carbon Engineering provides the technology. Now, Oxy wants to build the world's largest direct air capture plant in the Permian, could be operational in 2023 and capture up to 1 million tons of CO2 a year. Here's the potential price tag. At the cost of reaching Oxy's 2040 net zero emission target using direct air capture could be somewhere between $2 and $5 billion a year. Now, that cost can be offset in other ways, like using that CO2 to get more oil out of rock or tax credits. But you get the idea. It could be really expensive. Now, for Oxy, it's worth it. The company wants to make as much money pulling carbon out of the air and storing it for themselves and for others as it does in its chemical business in just 10 to 15 years. Now, I recently sat down with CEO HOLLUB just to see how all of this would work.
The reality is we have to have everything working. We have to have renewables. We have to have electric vehicles. We have to have investment in trees and in natural sinks like that. But you cannot do it without carbon capture. Every climate model by credible institutions insists that carbon capture has to be a huge part of this. We are experts in carbon management. We've done CO2 processing for a long time. The footprint we have in the Permian gives us the ability to not only handle the CO2 on the surface through our 14 CO2 processing plants and 2,500 miles of pipelines, but to also process it through the reservoir in a very efficient way. Our direct air capture is the facility that we intend to build in the Permian is important because you can extract CO2 from the atmosphere anywhere, and it doesn't have to be at the industrial site. So it's not a technology that's a trial and error kind of thing. We know it will work. We need just to get it to scale.
So you're basically then taking the knowledge that you have of carbon, the ability to use some of your infrastructure and the stuff that you make, and then pairing with the technology company to try and then scale this technology. I wonder what's your time frame? How long does that process take until you can have a real proof of concept and truly scale?
What we have to determine is how efficient can it be, and we do believe that we'll install the first one, and it won't be the most efficient, obviously. Just like wind and solar, everything is improved over time. We're going to start the construction probably in 2022 and bring it online in, we expect, late 2023. So we'll see the proof of concept probably by late 2023 or early 2024.
Do you anticipate at some point making money off of it because you're able to use the CO2 to make your oil wells more efficient? Or do you make money off of it by then renting this out to other companies that can't lower their emissions, like airplanes, for example? How does this fit into your business?
The benefit will be, and the way you make money on this is by increasing oil production. So you take the CO2, which ultimately will be at a lower cost than the CO2 that we get from organic sources today. So that CO2 lower cost, that's a way to increase our oil production at a lower cost. And also as we go into a lower carbon economy, everyone's going to need to lower their carbon footprint. So this gives people the incentive to come in and invest with us.
United Airlines, for example, made an investment in 1.5. And I wonder, what kind of sectors and interest are you getting?
We're getting interest not only from maritime companies, but from aviation companies, and also from technology companies, because data centers use a lot of energy.
How much is all this going to cost?
The cost, we haven't disclosed that yet because we're still in the early stages of the FEED study. We have just selected, but haven't yet announced, the engineering firm that will be putting the FEED together for us. We've done preliminary work on it. And so as we go through and work on the FEED study over the next 6 to 8 months, we will be able to determine exactly what, or pretty close to what the cost will be. But ultimately, this will be less expensive than the organic CO2 that we have today.
So I guess with cost, it's hard to model, but do you have an ideal return portfolio perspective? When everything's up and running and it's scalable and it's efficient, what's a return profile?
We will be competitive with our resources business. So if you do the calculation on what our resources business is generating for us, this is the exciting part of this for us. It makes the EOR business competitive with with resources for the first time in a long time.
If I talk to you in 15 years, are you still an oil company or are you a carbon capture technology company?
That gets back to what I was saying earlier. We are not afraid of the transition out of oil and gas because we are a part of that transition. We're the company that can make it happen. And so I do believe that in 15 to 20 years, more of our cash and income will be from carbon management than from oil and gas.
All right, time now for our commodities kicker. Don't bug out, but the European insect market just hit a major milestone. Yellow mealworms became the first bug to be found safe for human consumption by the EU Food Safety Agency. Dinner served. The EU decision could result in a booming edible insect market with mealworms wriggling up to supermarket shelves and dinner plates across the continent. And thanks to its high nutritional value and lower environmental impact, global insect farming is expected to grow tenfold by 2025. Just one more way to battle global warming. Oh yeah. That does it for Bloomberg Commodities Edge. Make sure to catch us each Thursday, 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.